Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Masterbrand Inc. Annual Report. Masterbrand Inc. offers a variety of residential cabinetry products that cater to different market needs. The company's product range includes stock, semi-custom, and premium cabinetry for kitchens, bathrooms, and other areas of the home. These products are sold through various channels such as dealers, retailers, and builders, who serve both remodeling and new construction markets in the United States and Canada. The company's business model is focused on providing a wide range of cabinetry solutions to meet the diverse needs of its customers. By offering different types of cabinetry products, Masterbrand can cater to various budgets and design preferences. The company's extensive product line and distribution network enable it to reach a broad customer base in North America. In addition to its core business of manufacturing and selling residential cabinets, Masterbrand also serves the remodeling and new construction markets through its dealers, retailers, and builders. This multi-channel approach allows the company to tap into different segments of the market and provide its products to customers who are looking for high-quality cabinetry solutions. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The decline of Masterbrand Inc.'s stock price over the past year is likely due to a combination of factors. One possible reason is poor financial performance, such as declining revenue or increasing debt levels. This could be attributed to various internal issues, including inefficient operations, lack of innovation, or ineffective management decisions. Another potential cause is external market conditions. A downturn in the housing market, which is closely tied to Masterbrand's business as a manufacturer of kitchen and bath products, could lead to decreased demand for its products and subsequently lower stock prices. Additionally, changes in consumer preferences or tastes may also contribute to a decline in sales and revenue. Furthermore, regulatory issues or compliance problems can also negatively impact a company's stock price. If Masterbrand Inc. is found to be non-compliant with industry regulations or laws, it could lead to fines, penalties, or even loss of business licenses, further eroding investor confidence and driving down the stock price. Lastly, market sentiment and investor perception can also play a significant role in determining a company's stock performance. If investors lose faith in Masterbrand Inc.'s ability to deliver strong returns, or if there are concerns about its long-term viability, it could lead to a sell-off of shares and further downward pressure on the stock price. Masterbrand Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Masterbrand Inc. trades at a higher price-to-earnings ratio of 56 times and a higher price-to-book ratio of 1.11 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key contributors include the acquisition of Supreme Cabinetry Brands, Inc., which has significantly boosted revenue. Additionally, the combination with American Woodmark Corporation is expected to further enhance revenue in 2026. Incremental sales from a full year of Supreme operations have also contributed to revenue growth. Furthermore, dealers' channel saw an increase in revenue from $1,421.3 million in 2024 to $1,500.4 million in 2025. However, not all drivers are positive. as lower than forecasted revenue growth rates and actual new construction and repair and remodel growth rates that fall below assumptions have hindered growth. On the decline side, factors such as decrease in assumed royalty rates, decline in discretionary consumer spending, and unfavorable foreign currency impact have contributed to a decline in revenue. The volatility of raw material prices, changes in trade policies, and competition from major retailers like Lowe's Companies, Inc. and the Home Depot, Inc. also pose challenges to revenue growth. The net income of a company underwent significant fluctuations between 2023 and 2025. In 2024, the net income decreased by $56.1 million compared to 2023, followed by a substantial drop of $99.2 million in 2025. This decline was largely attributed to increased bad debt provisions and other expenses. The profit margins also experienced a decline during this period. The margin dropped from 32.4% in 2023 to 25.7% and further decreased to 26.9% in 2025. Several factors contributed to these changes, including fluctuations in the housing market and general economy, unfavorable interest rates and inflation, decreased demand due to economic conditions, price competition from competitors, and increased costs from commodity price volatility. The company faced various challenges that impacted its financial performance. These included disruptions caused by global pandemics, IT system failures, tariffs on kitchen cabinets and vanities, AD/CVD investigations into imports of hardwood and decorative plywood products, higher manufacturing costs in Southeast Asia, and increased debt obligations. The cumulative effect of these factors resulted in a significant decline in net income and profit margins between 2023 and 2025. The company is indeed generating positive operating cash flow, as evident from the provided summary. One key indicator of this is the significant net cash provided by operating activities, which amounts to $195.7 million. This figure is further supported by the operating cash flow calculation, which stands at $133 million. Additionally, a notable component of operating cash flow is the $23.8 million generated from operating leases. Furthermore, the company's ability to manage its accounts receivable and generate net sales suggests that it has a strong grip on its financial operations, contributing to its positive operating cash flow. Overall, these indicators collectively point towards the company's ability to generate substantial positive operating cash flow, which is a crucial aspect of its financial health. The company's debt level has undergone significant fluctuations over the past few years. Initially, it increased substantially from $985 million to $1,712.4 million between two specific periods. However, this trend was short-lived as the debt decreased by $33.3 million in another period. Furthermore, a more recent update shows that total debt, fair value, actually decreased from $1,025.3 million in 2024 to $1,009.1 million in 2025. In contrast, interest expenses have remained relatively stable over the same time frame. Despite some minor fluctuations, there were no significant changes in interest expenses between 2024 and 2025 for most of the periods examined. However, it's worth noting that there was a slight increase of $8.1 million from 2023 to 2025. Overall, while debt levels have been volatile, interest expenses have remained relatively consistent. The performance of various segments and regions in the industry has been mixed. On the negative side, suppliers have struggled with manufacturing or sourcing interruptions, delays, and inefficiencies. Domestic operations have also experienced a decline, with a significant drop from $213.2 million in 2023 to $136.2 million in 2024. In contrast, some companies have performed well. Lowe's Companies, Inc. has seen steady growth, with increases of 20% in 2025 and 22% in 2024 compared to the previous year. The Home Depot, Inc. also reported positive results, with a 13% increase in 2025 and 15% in 2024. These companies have managed to buck the trend of declining domestic operations and supplier difficulties. Management is optimistic about the company's future growth, citing its unique combination of scale, operational agility, and strong continuous improvement culture as key drivers. The company plans to focus on reducing complexity in its product offering, leveraging technology and data to drive profitable growth, and expanding into e-commerce channels. To achieve this growth, management expects opportunities for value creation through strategic acquisitions and is focused on a disciplined process to identify, evaluate, and execute these deals. The company will also continue to invest in strategic initiatives, including digital and technology investments, marketing, and workforce alignment with forecasted demand. In terms of funding, management believes the company has adequate cash and credit facilities to meet its needs, including working capital requirements and projected capital expenditures. However, there are some uncertainties, such as the realization of deferred tax assets and the potential for a valuation allowance. Management is also expecting significant benefits from the acquisition of American Woodmark, which is expected to close in early 2026 subject to regulatory clearance. The company expects to realize synergies that will drive future growth and has identified intangible amortization expenses of $25.6 million annually from 2026 through 2030. Overall, management's strategy focuses on leveraging technology, data, and strategic acquisitions to drive profitable growth and extend the company's competitive advantages. The company's financial activities have been documented in various sections of its reports. One notable activity is the share buyback program, which was confirmed on page 23 as yes. This indicates a deliberate effort by the company to purchase back its own shares from the market. Further evidence supporting this claim can be found on page 79, where it is stated that the company has repurchased shares in both fiscal years 2025 and 2024. This suggests a consistent approach to share buybacks over the past 2 years. In contrast, there is no clear indication of dividend payments made by the company. The absence of any mention or reference to dividends in the provided text implies that this financial activity may not be relevant to the company's current operations. Supply chain disruptions and inventory buildup concerns the current business environment is plagued by concerns about supply chain disruptions and inventory buildup. Ongoing global supply chain issues, tariffs, elevated inflation, and difficulty in sourcing raw materials on a timely basis or for a cost-effective price are major concerns, page 8. Delays in providing customers with products on a timely basis could result in reduced or canceled orders, affecting manufacturing, distribution, and sales, page 10. The availability of commodities such as hardwoods, plywood, and particle board is decreasing, leading to increased costs. Potential labor disputes and work stoppages can disrupt operations, while global pandemics can impact suppliers' ability to supply key inputs, page 11. Uncertainty about future trade practices between countries, imposition of tariffs, and currency fluctuations are also causing concerns, page 13. Inventory buildup is another concern, with a decline in inventory worth $8 million in 2025 attributed to inventory management efforts, page 35. The industry is aware of the risks associated with inventory buildup, as evident from the affirmative response on page 59. The recent tornado at Jackson, Georgia production facility, 2023, caused damage and disrupted operations, further highlighting the vulnerability of supply chains to external factors, page 46. Tariffs on timber, lumber, and derivative wood products may increase input costs, while supply chain disruptions due to increased restrictions on global trade are also a concern, page 30. In conclusion, the industry is facing significant challenges related to supply chain disruptions and inventory buildup. Addressing these concerns will be crucial for businesses to remain competitive in the current market. That concludes the financial summary for Masterbrand Inc. Feel free to comment below, and I will be happy to answer them when possible.